Do you think that wealth is built through capital growth or through cash flow?
At the start of the boom, your rental return is high, you get the cash flow. You get the growth as well.
But you're also looking at that from a capital growth perspective.
The long-term average growth in every capital city in Australia, if you look back 50 to 60 years, is about 9%. It depends on where you're measured back from the end of the boom or the end of a plateau, but it's 8.5 to 9.5 over 40 to 50 years. That's growth, but the average net rent is about 3%. 3 to 3.5. About 3 times the return is from capital growth. But in a boom, the average growth is nearly 15 to 20% for 5 to 7 years. In a plateau, it's 0 to 2% per annum. Higher rents will help you make far more capital growth and equity. Then it's about learning how you buy more properties, how you use another property's growth to pay off the first one. Then when you get to the point where your net rent is starting to get okay, you can retire on liquidated equity and capital growth on about 5 to 10 times the net rent. When your property grows to the point where rent is high enough to be positive, there's a lot of equity in there. It's normally 50 to 70% equity. If people think you retire off net rent, that's assuming you never sell the property.
Yeah.
You never realise all the equity and capital growth. That is where most of the value is. We teach people how to grow the portfolio, but then in those high yield, high growth markets, you buy multiple. You only need 4 to 7 properties to retire on more than your current income. Everyone can do it. They set their mind to it. But it's not on net rent. It's partly on net rent. It's about a quarter of it. The rest is on the equity you've accumulated through capital growth. And you start to sell some of those properties down. You might leave 1 or 2 for the kids' inheritance, but I'm a believer in
Depends how nice your kids are to you.
The biggest gift you can give them is encourage them to learn this from a young age. Then they can have more than us. If it's taken me 10, 20 years to get really good at this, I teach clients in 4 to 5 hours how to retire in 5 to 10 years on far more than their current income. Imagine kids learning that as a young adult in their late teens or early 20s. If I knew it when I started at about 20 years old, I could have retired at 30 really comfortably.
Is there a preference when you're looking at these markets that say, okay, this is going to grow? Are you looking at a particular type of property? Like, are you looking at units, houses?
All the types. We typically break it up into units, townhouses and houses, but you even break units up into 1, 2 and 3 beds. More like 1 to 2 versus 3. They all have a slightly different cycle. Typically, houses grow first, especially if interest rates are flat or going down. And then houses will grow faster than the units and townhouses. If you think of a 3-bedroom house and a 3-bedroom unit in the same suburb, perhaps even the same street, one can't grow more than the other for more than 7 years because you get this enormous gap. The house might get to 2 or 3 million, 3-bedroom unit might be $1 million. Is somebody going to pay $3 million for a 3-bedroom house versus $1 million for a 3-bedroom unit? They won't. Normally houses go first, then normally townhouses go next, then 3-bedroom units, and then 1 to 2-bedroom units. And there's a cycle in all of them.
Interesting.
And we track that. We have the data for it back 60 years. We track the price difference between all of those intercity markets and then inter-property markets, so houses versus units or versus townhouses. It's like a wave of price difference. And it can oscillate by a huge degree, especially across different capital cities.
Very interesting. When investors or guys getting into property investment are looking at certain data points, what's one of the ones that you see they're paying attention to?
Yeah, absolutely. God bless the media, but it's really interesting that it's a big part of the psychology of the cycle, and it's a bit like what Warren Buffett talks about. At the top of the cycle, a lot of the market are really positive and buoyant, and so is the media. You should typically do the opposite to what the media makes out you should do.
Yeah.
They're very positive at the top. They don't want to buy at the top. They're very negative at the bottom. They will just, they'll be reporting, oh, this suburb's just had this amazing growth for the last year or 2. If you get that right at the start, that's okay, but most of the time they're not so positive right at the start. It's when it's had 100% growth over the last 5 years, and they're positive, is not when you want to buy in that market.
Yeah.
When you're looking at other markets.
You spend a lot of time looking at data and numbers. How important are things like infrastructure projects, those sort of fundamental things?
Really important, but we almost never look at anything under $1 billion. To put it in context, everyone gets excited about the Olympics and what that can do. The Sydney Olympics helped Sydney have a roughly double boom of about 240% leading up to and a few years beyond the Olympics. Brisbane's obviously got the Olympics next in 7 years, in 2032. It's already had a good run of growth. There's about 40 to 60 billion of major projects.
Wow.
That moves the needle, 40 to 60 billion. But also it probably has a bit of a leverage effect with a lot of media attention on that area. It's a bit more fuel. It's like another gear in that infrastructure. You compare that to Adelaide, half the size of Brisbane, about 10 times Brisbane's Olympics, with half the population. It is the largest infrastructure group of projects we have ever had in Australia's history by something like 8 to 10 times.
Wow.
It's like they've got the Olympics every 3 to 5 years. Most of those projects are inside the capital city. It's not like the Perth boom that was resources. Most of those projects were 500 to 1,500 kilometres or 3,000 kilometres from the city.
But Adelaide has that too, right?
A lot of resources as well.
Yeah.
The biggest chunk of it is the AUKUS project, the nuclear submarines. It's not just nuclear submarines, it's frigates, patrol boats, upgrade of the Collins class submarines to last as long as till we can get the first nuclear one. That's about 300 of the 400 billion. Now, a lot of people get concerned that Trump gets a bit erratic. There's high risk he'll cancel that project. We've already had bipartisan support in the US. There's been 2 elections since we agreed to get them. In Australia, the UK and the US. So they're deeply committed. It's probably the most significant military and sovereign capability we've ever had in Australia. So it's critically important to Australia, but the UK and US, to have that capability. Nuclear submarine, you don't need to refuel for 30 years.